Good morning, everyone, and thank you for attending today's webinar, Understanding DDP, Managing Duties, Taxes, and Trade Compliance. My name is Rachel Dean, and I'm a Senior Trade Advisory Associate here at Flexport. We have a lot of content to cover, but before we begin, I'd like to go over a few housekeeping items. On your screen, you will see a sidebar to the right of the main stage where you can submit questions. At the end of the webinar, we'll save a few minutes for you to ask some questions, so please get your questions in early. In the same sidebar, you will see a tab labeled Docs. This is where you can download a copy of today's slide and other helpful information. Above your screen, you have a button to request a duty drawback analysis from Flexport. We will review this in further detail later in the presentation, but please click that button if you would like Flexport to reach out to discuss a drawback opportunity for your business. Now, a brief legal note. Please keep in mind that all information provided in this session is based on the situation at this current time and may not be customized to your specific business requirements. We always recommend reaching out to a Flexport expert to discuss your particular situation. Joining me today is my colleague, Jenn Parks, and Director of Trade Advisory here at Flexport. So on today's agenda, we're going to be going over Incoterms. What is DDP? The benefits of DDP, DDP considerations, informed decision-making, and then a few Q&A. So with that, I'm going to turn things over to Jenn to give you an overview of Incoterms.
All right, thanks, Rachel. Before we dive into DDP, we thought it'd be helpful to provide an overview of Incoterms. So if we go to the next slide, all right, just wanted to provide you some background. So DDP is an Incoterm. What is an Incoterm? Incoterm is an international commercial term defined by the International Chamber of Commerce. It started in 1936. There have been several versions published since then, with the latest version being published in 2020. Why are Incoterms important? Because they provide a standard set of terms to eliminate potential confusion between a buyer and a seller in outlining their responsibilities and their obligations in an international transaction. Today, there are 11 globally recognized rules. If you see on your slide there's 11 that goes down from starting from X-Works all the way down to DDP. The three-letter acronyms will specify who arranges and pays for shipping, customs, insurance, and when the risk of loss will transfer between from the seller to the buyer. In order for an Incoterm to be effective, you have to remember that it needs to be referenced in an actual contract or a binding document. So if you're verbally discussing DDP with your supplier, that is not effective. You want to make sure that it's documented in some sort of written contract. All right, and if we go to the next slide. We wanted to highlight what Incoterms do cover. Speaking with a lot of clients, they are confused as to, we have a DDP Incoterm, or we do have an Incoterm on our contract. Doesn't that cover everything? No, it does not, unfortunately. If you see on the left side, it shows you that it does cover the loss of goods. So who bears that risk should the goods get stolen, lost, or destroyed during transit? It does cover who's responsible for export clearance, the freight, so the unloading, loading, destination to the port, to the truck. So all of that is kind of covered in an Incoterm. It does also show who's obligated and responsible for the import clearance on the destination side. And insurance. Insurance is only covered for, I believe, 2 separate Incoterms. For majority, it's not covered. So if we switch over to the right side, it shows you what the Incoterms do not cover. So it does not indicate when the title or ownership of the goods passes from the seller to the buyer. This is very important. This comes up a lot in times when we're doing first sale reviews where, we're trying to identify when the title passes, and we usually look at the contract itself. It's not something that's outlined in an Incoterm, so that's something important to know. It also does not cover contract price or the payment terms. Liabilities, so it does not cover who's liable for when the goods do not conform to the sale. Also, as mentioned right before, the insurance. So I would say 9 of them don't cover who's responsible for insurance. That's something that can be negotiated. And for the items that are listed on the right side, you want to make sure that this is negotiated and also identified in an actual contract with your supplier. All right, we can go to the next slide. So what is DDP? We hear a lot about DDP, more so today than before, because we hear from US companies that suppliers are reaching out, asking if they want to switch over to DDP to help alleviate some of the tariff burden. But we wanted to kind of give you an overview of what DDP means. What are the benefits of it? What are some risks and considerations that you as a US company should have before making that switch? So unfortunately, we're not going to go through and say you should definitely switch to DDP or you shouldn't. We're not going to give you an answer to that. But our objective of this webinar is to make sure that you have all the right information in front of you to make that informed decision to see if it is right for your company to make that switch from current Incoterms, whether it's Ex Works, FOB, to a DDP term. So as we dive into DDP, we wanted to highlight, what does DDP cover? When you have a DDP term, you also want to make sure that there is a named place of destination. You don't want a contract that just says DDP, because it's vague as to where the goods should be delivered to. So you want to make sure that there is an actual indication. So DDP and a named place of destination should be on there. In the parentheses, it's usually a buyer's warehouse or wherever that's agreed upon. As you know, in the left-hand side, we will kind of go through what is a seller responsible for. In a DDP transaction, the seller ultimately bears all of the risks and costs for the transaction. DDP is looked at the exact opposite of Ex Works. So if you see on that chart there, Ex Works is when the buyer is responsible for all the costs and the goods for the goods. But if you look at DDP, it's the exact opposite, where the seller bears all the costs and the responsibilities from the origin to the named place of destination. So they'll be responsible for the freight. They'll be responsible for export clearance in the origin country, the transportation, but also import clearance in the destination country. And I would say, for purposes of this webinar, we'll be focusing on destination as the US. For the buyer, you'll notice that all they have to do is accept the freight, the goods. So they have no responsibility until the goods arrive at that named place of destination, which is just receiving the goods. All right, and if we go to the next slide. The benefits of a DDP. So as mentioned, we are focusing as US as a destination, and also as the US company as the buyer here in our scenarios. But the benefits of a DDP is, if you're a US company, you are not responsible for the shipment or the delivery, right? So currently in your situation, you may have a supplier or a seller that is located overseas, let's say in China, Thailand, Vietnam, wherever they may be. One of the responsibilities you may have in Ex Works is that export customs clearance, understanding the transportation rules in that country so that you're able to get your goods out of that country. But under DDP, you're no longer responsible for that. So it might be, you may be relieved. It may be easier so that you don't have to focus on that anymore. But also from the US perspective, on the destination side, you're no longer the US importer of record. It's the seller that ultimately is now the importer of record in a DDP transaction. So what does that mean? That means that you as a US company are no longer responsible for any customs obligations here in the US, which includes duties, tariffs, fees. You're no longer working with a broker to make sure your broker is providing the correct information on your products on the 7501. You don't have to get a customs bond, or you don't need a tax ID. There are a number of things that kind of removes you from a lot of the responsibilities that you previously had. And this may look really good, right? You were in a situation, especially in today's landscape, where maybe you no longer want to be an importer of record. You don't want to deal with everything that's happening. You don't want to, constantly update your classification, your duty rates, tariffs, knowing that, the amount that you're paying in tariffs is constantly changing and trying to keep up with that. So before you think this is great, like, why wouldn't I want to be in the situation where I'm no longer responsible for all the customs obligations here in the US? The next few slides we'll be discussing why we think there are a lot of risks that may be involved with switching to a DDP term as a US company. And so I'll invite Rachel Dean back on to help explain some of the risks that she sees. Yeah.
Thanks, Jen. Well, I think it helps whenever we discuss Incoterms, but especially when we talk about switching over to DDP, you can go to the next slide, is to break it down into two sets of obligations under the Incoterms. We have the transportation, so like the physically moving your widgets from A to B, and then also looking at it from a regulatory standpoint. But to start off, let's go and dive into the transportation. Now, we know that when we're operating under DDP, everything lies with the supplier. So they are going to be responsible for physically moving your goods from point A to point B. Now, the thing to take and to really kind of mull over is the priorities for your supplier overseas are going to be different than your objectives here in the United States. So when you're talking about cost associated with moving the freight, your supplier overseas is going to be going for probably the cheapest option. They're going to be trying to find, if they're passing on those charges to you, I mean, that's looped into their group price that they're billing you for, but they're going to want to make it the cheapest option available. And sometimes that involves not the best routing. I have seen shipments take very interesting trips across our planet to get from point A to point B just because it was the cheapest option available to the supplier. However, for you, obviously, we're very concerned about keeping costs down. But for you as a party in the United States waiting for your goods to arrive, there are costs associated with delays. And what does that mean to you? What does that mean to your customers that are depending on you to get them their goods in a timely fashion? So that's a difference in looking at that, the value, the cost of what it takes to move the freight from point A to point B. And another consideration around that is, even though they're taking on that responsibility to move the freight for you, their contracts that they have with steamship lines and with forwarders may not be as good as yours. So that the cost that they're ultimately paying for the freight may not be, number one, it may not be a very good transit time, and it may be higher than what you're able to acquire for your freight, to move your freight. So you need to be aware of these things. And also visibility. You need to know where your freight is. And if you have to depend on your supplier overseas to give you updates, think about the delays that might come up from that. So if you have a supplier that is very prompt into responding, like you send them an email, they respond quickly and promptly and timely, maybe you can depend on them giving you notifications on the status of your shipment quickly. But is that something that you really want to turn over all that power and responsibility over to another party so you don't have that visibility? And if you're not a notified party on a bill of lading, is the ultimate consequence, if you're not that notified party, you may not get any notices if there is a delay. So we're looking about turning all of our responsibility over to our supplier, what the considerations are. Now, how does this kind of play out? And what are some of the scenarios that can come into play? What are some of the impacts? So let's say, for example, something like a very simple issue that you could probably resolve within a couple hours. Let's say you have an LCL shipment and your cargo is loaded with 20 other shipments, and the warehouse is segregating the freight, and there is a warehouse marking hold. They want the packing list and bill of lading just to make sure that they are segregating the freight properly, and this bill of lading is going here and this bill of lading is going there, and they're not mixing any of the cargo up. Well, they would send out a notice, and then you could respond to it within an hour or two, give them the packing list and get it resolved, and everything's great and good. However, if you are not responsible for the freight anymore, you're not the notified party, you may not even know that there's an issue. Maybe they're going back to the supplier overseas. Is that going to be a priority for your supplier overseas to resolve that issue? Are they going to even know that it's an issue? Also, think about diversions. Like maybe there's a port strike or there's congestion in a port and you're like, oh my gosh, I need these goods very quickly. I want to have them offloaded in LA, and instead of moving on the rail, let's do a diversion, and I will get my freight in LA and I will truck it across the country because it's worth it to me to pay the extra charges for freight to get it more timely. How are you going to navigate that situation with your supplier overseas? Because you're not in control of your freight anymore. So those are the type of considerations and things you need to think about when you're thinking about switching to DDP. What matters to you, and and your clients and the people that are depending on you for getting their widgets or their goods. So, Jen, is there anything else that can kind of pop to mind when you think about concerns around transportation in DDP?
No, I think just to add on to what you were saying in terms of the timeliness of resolving those issues. So if you have a supplier overseas, typically the time difference does make an impact, right? So if you were notified of an issue, during the daytime here in the US, it's nighttime over there. So, you have to wait a full 12 hours or so for even addressing or even knowing about an issue. So that's another thing to consider if you are an importer or you were an importer, but you are the US company waiting for your goods to arrive. There's going to be different factors that play into when you can respond to an issue, but also get your goods, and you have no control. You're just waiting for your supplier to hopefully resolve those issues on your behalf so your goods can still arrive on time, and just trust that they will respond timely. But I think, Rachel, you're right that those are issues that are no longer in your control anymore, but you're just relying on your suppliers, which I think is why we want to express here during this webinar that if you do switch to DDP, you want to make sure you're working with a supplier that you really trust and you have a good relationship with, and that knows what your objectives and goals are, so that they would put that and consider that as they're discussing their costs and fees and who their strategic partners are in freight forwarding. So, yeah.
Oh, Jen, you're on mute.
Sorry about that. Okay, so we can go through the regulatory risk. So for this slide, we wanted to really focus on the U.S. destination and focus on customs compliance. So as we mentioned, seller is responsible for export and import customs clearance. Supplier is the importer of record. So you as a U.S. company are no longer the importer of record. And the supplier may possibly be a non-resident importer. So if they don't have a U.S. presence, they may have an agent or maybe an employee here that, and they're working as a non-resident importer. And so there are some risks with that, which we'll kind of go through in our considerations and impacts. So first, we'll kind of talk about the lack of visibility and control. Similar to transportation, same thing here in customs compliance side. Before, you're probably used to working closely with your broker to make sure that the information that you're supplying to them about your products is accurate, that you have the right, descriptions, the classifications, origin, even if there's a PGA license that's required, you're working closely with them to make sure that they have all of that on hand. Why? Because not only do you want to make sure that you're compliant and making your goods are being declared correctly, but also you want to avoid any sort of detention seizure from customs, which could have trickle effects down to your goods being delayed and impacting your customers. So when we focus on the U.S. and your supplier, what I just mentioned is you want to make sure you have a supplier that you trust. Do you know whether your supplier has a presence here in the US? Do they have employees here that fully understand the US customs rules and regulations, and also the partner government agency requirements, so that when you are clearing goods, that they have the best interest of your goods in mind when they're declaring the information that pertains, so the classification, origin, and all of that. They may not have the experience nor the knowledge around valuation, or how goods should be declared to customs, or even the classification. There are scenarios where we've had companies come to us saying they're switching from DDP to now they want to be the importer of record because they want more control of their goods. And in those instances, one of the things that we advise in compliance is, do you know what classifications they've been using? Do we need to do a classification exercise to make sure that the classification you're going to be declaring to customs on those goods as an import of record is accurate? So, you want to you want to do that vetting. And oftentimes, I would say majority of the time, the classifications that the manufacturers were using under DDP terms for a U.S. company's goods were incorrect. And so we had to update those classifications. So reverse scenario, if your supplier is now declaring the classifications, do you know that they're going to be declaring the correct classifications for your goods? We'll go through in in a few slides why that's still important, even if you're not the importer of record, to make sure that classifications are correct for your goods, even if you're not the importer of record. But you just want to make sure that the supplier you're working with is knowledgeable about the U.S. customs regulations, the other partner government agency requirements that may be applied to your products, if it's, a food product, or if it has fish and wildlife attached to it. But also, do they have good relationship with their customs brokers? As you know, as a U.S. importer, you want to make sure that you have a good relationship with your customs brokers. There is that saying, you marry your customs broker, because they are declaring information on your behalf. They have your best interest at heart, making sure that the information you tell them to declare is what is being declared, and they're notifying you should any issues come up immediately from customs, or any detentions, any seizures, to make sure that those are being resolved timely. And so a lot can happen in terms of having a supplier overseas who doesn't have a U.S. presence, because of, what I mentioned previously on that slide is the timeliness issue. And if an issue comes up today at 8 a.m. from customs, the supplier is not going to get that notification until a full day later, and you're waiting for your goods to arrive. We have clients that are like, I need my goods released today, in a few hours. My customers are waiting on it, and in those types of scenarios, you just can't do anything if your supplier is the importer of record, because they're the ones that are going to be responsible for responding to customs on those issues. And also, one thing we do want to call out for consideration is, under the current administration, there are changes anticipated for non-resident importers. It is possible that it may be eliminated, or that the rules around NRIs may change. So if you switch over to DDP and your supplier is importing as an NRI, non-resident importer, and the rules change in a few months, you're in a situation where your suppliers no longer can import the goods, right? So what do you do in that scenario? You need to figure out whether you're going to be the importer of record. But just dealing with that scenario and what if scenario is something that is a risk that you would want to consider. And also on the impact side is that if you do have a supplier that is a importer of record here, and they're not well versed in U.S. regulations, PGA requirements, it does impact your goods. So it does impact them, probably the information being declared to customs, which could be the classification, origin, or the value. And this could ultimately lead to incorrect tariffs and duties on your products. So if these costs are being baked into your goods, they could be charging you more than what they should be, because they have an incorrect classification with a higher duty rate than what it should be. Also, the delays and seizures of your goods. As you know, if you get a CF 28 or 29, there is information that customs will be requesting of the importer of record to confirm or validate the classification, country of origin. And let's just say for a free trade agreement claim or an origin claim, there is a significant amount of documents that customs typically ask. Is your supplier well versed enough to understand all the documents that need to be supplied to customs to vet that country of origin, to make sure that customs does not question it or reverse your country of origin claim. So you want to make sure that your supplier obviously has the right knowledge and experience in order to avoid these potential issues. Even though the responsibility lays with the importer of record, so the supplier, it's ultimately going to affect your goods coming into the country, right? The timeliness. And if you don't have goods on time, that does affect your customers, your reputation, your contracts. So that's something to consider. Another last point that I wanted to call out for the impacts on the regulatory risk is that you may not be eligible for any refunds. If you're not the importer of record, generally the importer of record is eligible for refunds when you're filing a PSC or a protest. So consider the IEEPA tariff litigation today. I know we're all anticipating and waiting for that Supreme Court decision on the IEEPA tariff litigation. But for U.S. companies that have paid all those tariffs, I think one thing that they're waiting for is, can I get those refunds back? But if you're not the importer of record on those goods, you may not be eligible for those refunds. So you're not sure how those costs are going to be baked into your cost if the supplier is the importer of record. So they're the ones technically that are eligible for those refunds. Oh. All right. So we went through some of the transportation and regulatory risks, and we called out, the supplier is ultimately responsible for the information declared to customs, and so a lot of instances when I work with clients, they're like, we're not, we don't know what, under DDP terms, some of the responses that we get is, we shouldn't be held reliable because, we don't really know what's going on with the information being supplied by the supplier, right? It's just, we're just receiving the goods. The supplier should be responsible. They should be the one exercising reasonable care for, classification, origin, all the information declared to customs. But Rachel, is that true? Is a U.S. company that is not an importer of record, but maybe the ultimate consignee on these shipments, will they be held liable, or is there anything that they should be considering?
Right. Absolutely. Like, as an ultimate consignee, you can be liable. So like we talked about the transportation, we talked about the regulatory, you've got your goods, you've played your supplier, everything's done and everything's beautiful. So you don't think that there's anything that you would need to worry about. But that's not necessarily the case. The more severe issues are actually going to arise, the potentially more severe issues or more worrisome issues are going to arise after your goods have delivered, and maybe there's a CF-28 or 29 or a customs audit. And depending on the potential consequences and the severity of some infractions, the Homeland Security Investigations, HSI, which is under ICE, could actually get involved if criminal actions are involved. But here we have two pieces of legislation that we're kind of referencing that may come into play, and they do affect the ultimate consignee. So first off here, we see the 19 U.S.C. 1592, which states that no person, it's not stating importer of record, it's no person, by fraud or gross negligence or negligence. So those are the different standards of care. It doesn't just matter, like, are you directly lying to the U.S.? Like, obviously that's wrong, but negligence as well, may aid, abet any person in violating these clauses. So just because you're not acting as the importer of record doesn't mean you can say, like, I wash my hands. So like, if you have somebody come to you and you says like, hey, I know that you've been paying $200 for this in fees to get this good in, but I can do it for $150. Okay. Let's use your everyday skills. If my 13-year-old came up to me and say, hey, Mom, I got this great deal for you. I know that there's things that's been costing $200, but I'm going to get it to you for $150. I would raise all the red flags and I would be like, slow your roll. Let's look at this a little more closely. So those reasoning skills, just because you're not acting as the importer of record, you don't get to just shut off your everyday reasoning and rationale skills to say, like, it's fine because I'm not the importer of record. Because we know under these pieces of legislation that you too can be held liable. One of the kind of watershed cases that was decided under this 1592 is the case from 2014, the Trek leather. Now, this was an issue where it was a undervaluing of goods being entered into U.S. commerce, and the importer of record, Trek leather, was not properly claiming assist. So rather than claiming duties against $100, they were only claiming the duties against like $50 worth of goods. So when you improperly value your goods, the duties aren't being properly assessed at the right value. So U.S. Customs is being denied some of the funds that they're entitled to for these entries. So in this particular case, Trek Leather, as the importer of record, and one of the executives that worked for Trek Leather were both found liable for gross negligence. And in the decision of the court, they made it clear that this idea of an individual introducing or attempting to enter or introduce merchandise into commerce was a wide definition. It didn't just have to be the importer of record. It could be the ultimate consignee. It could be an individual that's giving direction to bring these goods in. So that's one example. And another decision that was also decided under this 1592 was the U.S. Customs versus International Trading Services, which was involving a misclassification. They were intentionally using a misclassification of sugar to get a lower applicable duty rate. And again, it's a case where the importer of record was the company, so International Trading Services, or ITS, was held liable for negligence, but also the CEO of the company was held liable as well. So let's look at this other piece of legislation, the False Claims Act, or also known as the Whistleblower Act, under 31 U.S.C. 3729. Now, the FCA provides that any person who knowingly submits or causes to submit on your behalf, false claims to the government is liable for 3 times the government's damages plus a penalty that's linked to inflation. Now, this is one that you're hearing a lot of people in compliance talk about because just recently, in August of this year, there was a decision that came down against Allied Stone, and it was a $12.4 million anti-dumping duty evasion case for courts. And again, it's the company that was acting as the importer of record, and then executives at the company were also held liable. So the thing that makes it a whistleblower act is that the person who brought this to customs attention actually gets a portion of the settlement proceeds. So if an individual sees anything, if you see something wrong, say something. So that person received over $2 million in proceeds from this ruling. So the idea that you can just be willfully ignorant of how imports are being handled that you're benefiting from, you're like, hey, I paid my supplier, I received my goods, everything's done and good and fine and dandy, I don't have to worry about it. It's not necessarily the case. So let's go to the next section here, and informed decision making. So now we've kind of gone over everything. We talked about some of the risks and things you need to consider when you talk about transportation. We've talked about what you need to decide to think about on the regulatory side. And then after it's delivered, like some of the issues that could come up that are legal concerns. So as you're sitting there and you're thinking about like, how do I want to handle this? Like, do I need to switch to DDP? Do I need to change my Incoterms? What are my expectations? The very first thing I would ask you is, how well do you know your supplier or seller? This is across the board. It doesn't matter if it's Ex-Works, FOB, or DDP. How well do you know your supplier overseas? If you are going to hand over all this responsibility to them, this party overseas is going to be responsible for moving your freight, for handling all the regulatory filings for it. You need to know them even more so. Like you're depending on them to represent this to all these government agencies for your benefit. Your understanding of their operations and how they do things is even higher than it would be if it was FOB or Ex-Works. Also, have you conducted an internal review to confirm whether the benefits outweigh the risks? How is this going to change your current processes? Do you already have a good understanding of how your goods are declared to U.S. Customs? If they require other government agencies, do you know how it's declared to FDA? Do you know the valuation, country of origin, classification? Do you already have a really good grasp on that? So when you're working with a supplier overseas, if you are going to turn over this responsibility to them, do you know and can you ask them the questions to make sure that they're doing it properly? When we talk about current processes, like how do you receive freight? How often do you have to do diversions? How often do you want to get involved or you need to expedite something? How much is this going to turning all this responsibility over to another party? How is that going to affect your operations? Does your seller have a good understanding of DDP? And this is one of the things that comes up across the board. I think that there's got to be a meeting of minds. Like your supplier overseas and you here in the United States need to understand what the expectations are. I'm always amazed under Incoterms how many like misunderstandings pop up because your seller supplier, even with something like DDP where everything really should be their responsibility. I've seen cases where they're like, well, there was an exam hold. We weren't expecting to deal with an exam hold. So you're going to need to handle that in the United States. Even though that's clearly tied to customs, there's still that expectation from the seller supplier that that's going to be handled by the US party. But if you're not on any of the customs documentation, if you're not the import of record and you're not on the bill of lading, or what can you honestly do? So make sure that there's a good understanding of who is responsible for what, regardless of the Incoterm, but especially with DDP. Does your seller have employees in the United States who understand U.S. Customs law and regulations? We know how complicated it can be to navigate country of origin determinations, how to navigate all these different tariffs that are applicable under Section 232 and IEEPA. It's difficult for us to understand it, and we're seeped in it. Like we deal with it every day. How is that party overseas going to be capable? How are they equipped to handle those changes? And some of these changes in our current environment are happening very quickly. Like we'll get an announcement for Section 232, and then a couple days later, it'll be applied to your imports. Are they capable of dealing with that? If your seller is set up as a non-resident importer, are they already acting as an importer of record in the United States? And if there is a change in regulations that affect who can act as a non-resident importer, or if they get rid of it altogether, how's that shakeup going to affect your operations? So when we're talking about shifting Incoterms, if you're thinking about DDP, have you also considered other duty saving opportunities? So with that, I'm going to let Jen jump into the next slide here.
Okay. And what we're trying to say is, DDP may be right for your business, it may not. We just want to provide you with all of the information that you would need to consider or want to consider before making that switch. And I think Rachel kind of highlighted clearly on that slide, some things that you may want to consider with your supplier before making that switch. Just from experience, I work with a lot of companies, and just dealing with them and, the information they're able to pull from their supplier is very limited. We have situations where the supplier does not want to provide certain documentation to vet some of the information we need to declare to customs, or they may just not understand what is being requested from customs. So there's a lot of, learning that happens at that time. So, I would say suppliers aren't well versed in US customs regulations. I know even for us US companies, it's hard to navigate these rules and regulations, especially in today's landscape where everything is changing constantly. So what we're saying is you want to make sure that your relationship with your supplier is stronger than ever, not only for DDP, but just in general. Because right now there is heightened CP scrutiny all across. They're making sure that companies are paying their tariffs. As you can imagine, being in our side, companies are reaching out, trying to figure out what they can do with their current process to reduce the tariffs that they have to pay. They don't want to pay 100%. They don't want to pay 65% on goods when they were used to paying 5.3% on, just the general duty rate. So we have been working a lot with clients, and the way that we have been assisting them is not through an Incoterm change, which could be good for you, but other ways is, we're working with them to, look at changing their country of origin, if they're looking to transition their supply chain so that they're shifting certain manufacturing, assembly, or even raw materials from one location to another so that they can have a new origin that's non-China or non-Thailand, and to a new country that has a lower duty rate, and maybe potentially also seeing if there's a free trade agreement that could be utilized so that there's no duty at all. So I would say free trade agreement qualification is something that has been coming up. And I know shifting your supply chain is not for everyone. It is expensive. It does take time. So in those scenarios, we do look at classification. We have a lot of companies really validating their classification to make sure it's correct, because they're shocked when they see the amount of tariffs that they need to pay on their products. So they just want to, have that peace of mind that the classification at least is correct. There are situations we find a new classification because the one that they were previously using may have been outdated, or it just wasn't the correct one that they should have been using. But also, Chapter 98 reviews have been very high in demand. So they're looking at 98 as a provision to bring their goods in duty free. So there are certain rules in Chapter 98 programs. So there's the Nairobi Protocol, U.S. goods return, agricultural use. There's a few where companies previously have not utilized it, even if they did qualify, because their duties and tariffs weren't high, so there was no need to really go through the process of doing that review and getting the documentation together to claim those. But now with the high tariffs, they are now pursuing to see if they qualify under any of these programs to get those goods in duty free. So that's another avenue that companies have been utilizing to mitigate some of the tariffs. Also value. So if your classification country of origin, there's nothing you can potentially do with that, and it's correct. valuation is another area. So the reason why we focus on country of origin, tariff, and value is because those are the three areas that drive duties and tariffs for your goods. So you want to make sure not only are they accurate, but seeing, are there any ways within these three that you can, change things a bit so that the duties and tariffs can go down on your imports. Another one that has come up because of just confusion, especially because everything is changing every day, is Section 232, the tariffs on steel, aluminum, copper. So there is the derivatives, right? So companies are asking, what is that steel value that we should be reporting on these derivatives, right? And some companies don't even have a process in place to be able to split out that steel tariff line, so the steel line. So we're working with companies to really identify what should be reported, how it should be documented, so that if customs does ask, that they have proper documentation in place to prove that it should only be that 40% or 30% instead of that 100% of their finished good. So I would say if DDP is not something that you would want to explore, considering some of the risks that you just saw in our webinar, we would also look at some of these as potential ways to reduce some tariffs. And then if you go to the next slide, there are other ways that Flexport can support you as well. As Rachel had mentioned at the beginning of the webinar, there's a duty drawback analysis. So if your annual drawback claim is over $1 million, click the request drawback analysis button above your screen. We'll run a free detailed analysis using your ACE data. No new data is needed for this, and there's no obligation. So this is complimentary. You'll get a report with the estimated recovery, eligibility gap map, and a compliance check and an action plan. So as mentioned, this is only if your claims exceed 1 million. We're happy to do this free of charge. Next is if you want a complimentary ACE analysis, please vote yes in the poll. We'll analyze 5 years of your import data to spot any duty savings, compliance risks, and missed cost savings opportunities. And we also encourage you to use our tariff simulator. If you haven't used it already, we find that a lot of companies find it very helpful to get instant tariff and landed cost estimates, especially when tariffs are changing, I would say every month, sometimes weekly. So if you just want to get the latest, we do run this is real-time changes. So it's very quick in terms of the updates that we provide in the tariff simulator. So we would encourage you to use that as well. And if you have any other questions, or if you want to contact any of our experts to discuss any of what we've discussed today, we have our emails that we've listed here as well. All right, and with that, we have a few minutes left. I know we kind of ran over on our content portion, but we will take the time to answer some of the audience questions. A reminder to add your questions to the Q&A function on the right. And if we don't get through all your questions today on this webinar, we will try to reach out offline. And then we will also open up our feedback survey at this time. Please share your feedback on today's webinar so we can continue to create great content for you. Okay, so with that, we'll dive into the first question. I'll start with Rachel. When you say responsible for with respect to the activities associated with Incoterms, with whom is a party responsible for?
When you say responsible with respect to activities associated with Incoterms, with whom is the party responsible for? Incoterms lay out who is responsible for each of the activities regarding like the regulatory clearance, and then the physical movement over it. These are commercial responsibilities between the parties. And so who is responsible for paying freight? Who is responsible for handling the customs formalities, etc. For a couple of the Incoterms, who is responsible for handling the insurance? I think that's the clarification that they're wanting for that, but those are just kind of laying it out. It's a shorthand way of negotiating business with a overseas party, because Incoterms are accepted globally. So,
okay. All right. For e-commerce in DDP Incoterm, what amount would be used for the entered value? The price sold to the importer or the price sold to the ultimate consignee? I know this has been a question that has come up quite a bit, especially with de minimis going away. So I would say This is a very complicated topic. It's more of a fact-specific analysis, so I can't say it should be the importer of record, or it should the price sold to the importer or to the ultimate consignee. It would be a fact by analysis. So we would need to see how your transaction and your shipments are set up to really determine whether one value would fit more your scenario or the other. But there are rulings out there that cover topics on e-commerce valuation. So there is guidance out there, but to answer your question, it would depend on how your transactions and your shipments are set up today. Yep. Under DDP, would the seller be required to file ISF? Rachel, can you help answer that one?
Yes. Under DDP, it's all of the customs and regulatory. So it's all of the customs filings that they need to, for their own country, the origin country, to exit the country, but also as whatever requirements would be for entering into U.S. commerce. So ISF, the customs entry, anything that would be required by a PGA. So absolutely, any of those would be the responsibility of the seller acting as the importer of record. So yes.
Okay, and then here's another question. Transaction values shouldn't change depending on the Incoterm. How can shippers claim switching to DDP can alleviate tax burden? Does that not mean the shipper may be undervaluing the shipment? Yeah, so this is a good question. So when you may have had suppliers reach out saying, you should switch over to DDP, will help alleviate some of the tax burden for you, which sounds great, right? You want to share, having a company that wants to share that tax liability or the tariff liability with you. And then you just need to switch over and all the responsibility goes to your supplier and you're doing less with, a contract price that you are familiar with, right? You want to be very careful in this scenario because with the DDP, the seller is taking on a lot of the responsibilities, as we mentioned, right? A lot of the costs. So if you don't see your value going up, that's going to be something that you want to question, right? They're increasing their costs, for transportation, they're taking on all the customs clearance, they're paying the tariffs. But if you're seeing that their products are not being, your pricing is not changing, then it is possible that they may be undervaluing, that they may not be declaring the right classification. So the duties aren't as high as what you thought it was going to be. Or it is possible that they, as a non-resident importer, that maybe they have a related party transaction, supplier being imported, they may have a related party here in the US. So, they're able to have a lower cost because they're selling to the related party in the US. And that price may be lower because it's in a related party transaction. Oftentimes you'll have a price that's more favorable than what the supplier would be selling to other third parties or other companies. But in that type of scenario, you want to make sure as well that the related party transaction meets customs requirements, that there is a cost plus profit being on those transactions. And so it is possible that they may have a lower price and it meets the related party transaction requirements. So they're able to, have a favorable price to you as well. But you just want to make sure that the cost is changing and it's not a consistent price that you saw when you were the importer of record. And it's going to be hard. They're not going to, I don't see a scenario where the supplier will say, oh, we'll show you our commercial documents, we'll show you our 7501, we'll show you all the documents to prove how we came up with the pricing. Obviously, they're not going to disclose all that, but you do want to start questioning, saying, is this correct? Could you kind of explain how you're coming up with a price? Do you have a good relationship with your freight forwarder that you're able to get a lower cost? So you just want to make sure you're doing your due diligence and asking the right questions instead of, turning a blind eye saying, great, if we're able to keep our costs the way it is, then we don't have to worry about what's happening, behind the scenes. Let's just move forward with it because we're no longer the importer of record and I don't care what's happening there. That's a scenario we just want you to avoid. You want to make sure that you're constantly asking questions, working closely with your supplier, and you're working with a supplier that you really trust and that really understands U.S. regulations, but just has a good reputation in general.
If it seems too good to be true, it's too good to be true.
Yeah. All right. I know we're behind on time. I think we'll just ask one more question and then like I mentioned, if we don't get to your questions today, hopefully we'll answer them offline. If the seller imports a shipment under DDP but passes the customs duty fees onto the buyer on their invoice, is this still considered DDP because the seller was responsible for these costs to the service provider directly? So to customs, to the broker, etc. Rachel, can you help answer that one?
Whatever it is that you're paying, obviously, your seller supplier overseas is not going to incur additional expenses without passing them on. They're just like showing you a line item of what those charges are, so you're aware of them. So like if I gave you an invoice and I listed out, this is the value of goods, this is the value of the shipping. I mean, obviously there's an expectation that you're going to be, if my cost is going up as a seller supplier, those costs, I'm not going to go in the hole to sell and ship these goods to you. So they're just laying them out on the invoice. It's not, no. And actually in some ways that's kind of nice, because that way you do know what they're paying. There is an expectation that they are paying those duties at that level or whatever. So no, if they're laying it out on their invoice, it's not necessarily a change in the Incoterm. So,
Okay.
right. This concludes today's webinar. Thank you everyone for attending. We will email everyone a link to the recording tomorrow morning, and thank you again and have a great day.